Hey, everybody. Welcome to the Everyday Trader. This is Eric Hale with Trader Oasis, and I'm joined by my friend and partner, Greg Jensen.
It's a pleasure to be here, folks. Good to be with you again. It's been too
Greg's
long.
the CEO of Options Animal. So Options Animal helps people learn how to trade strategies, and Trader Oasis is a place to trade. Before we get too far down the path, if you like what you're seeing here and you want to see more of it, leave us some feedback down below. We got some really good questions. Maybe we should take some of those on. We didn't prepare for that, but there's one question that comes up a lot. So ask questions. We like that, and ask them down below. Don't email me. Don't follow me on social media. You can do that, but if you ask it down below, it helps the Google algorithm. So like, subscribe, and stay engaged in the comments. But before we get too far down the path of talking about what's happening today in the market, Jerome Powell, a very common question we get asked all the time, and I'm going to throw a curveball at you because I didn't prepare for this. You didn't prepare for this, but it's a question you get asked all the time. And it was the most common question that we've seen so far. And that is, how do I adjust?
Well, the adjustment process, good question, by the way. That's it really is one of the things that I would say is one of the edges that we have at Options Animal. We teach our clients, our people who learn how to trade with us and are part of our community, is we teach them this concept, this idea of, instead of using typical risk management that's taught inside of the investment community, what I'm referencing is stop losses. And that's what almost everyone teaches is, how to stop loss set at some percentage.
Or diversification.
Diversification.
And by the way, so we're clear what adjusting means is when you think your sentiment is the stock's going to go bullish or bearish or whatever, and you place a trade and it doesn't go in that direction. So what do you do?
Yeah. So the idea is exactly that. It's like, instead of relying on a stop loss to save my capital, what we do is we teach just this different mindset of how to view investing. And that is, don't give up on the trade. If I have a bullish trade on, and I'll just use a bull put as an example. If I do a bull put, a credit spread using put options that goes against me, a lot of times people just close that trade out if it's at risk of assignment, and they recognize some type of loss. Sometimes it's 10%, sometimes it's 50%, depending on how quickly the underlying equity is moving. But what we do instead is teach this idea of, well, what else could I turn that trade into to take advantage of now the new trend? So if it was bullish and I placed a bullish trade and then it goes bearish, well, I'm just going to morph the trade. And I can do that if I simply just understand the different instruments that are out there, from call options, put options, equity position, short position. And if I understand those, I can just make a little tweak to a trade, and all of a sudden I'm in a brand new trade, still on the same equity, that now has the probability increased of potentially winning. So that's the idea of adjustments. I mean, we have a whole education, a whole 7-level course teaching people this concept. So I wish I could teach you here in a 10-minute YouTube clip, but it's just not going to happen.
Well, there's a couple of points that thoughts that I had, and I thought about asking this question over the weekend. And I thought, like, okay, you are hands down the biggest fisherman that I know. You're a fantastic fly fisherman. And this guy, by the way, will walk into a stream, reach down, grab a rock, and tell which larva, because the flies that lay larvae down on the stream, he'll identify the larva and use the right fly to catch the flies. And he does a fantastic job. And for me to come in here and ask, hey, how do I trade? How do I adjust? Would be equivalent to asking you, Greg, how do I fish? I mean, you get a rod, you get a line, you put a hook and a lure at the end of it, and that's how you fish, right? It takes more than just those basics, and you have to start with the basics, and you have to start with the fundamentals, and helping people understand, looking at equities and determining, what's the fundamental, technical, sentimental reasons for why the stock is doing what it's doing. And then also not only that, but looking at the other components that affect the price of options. So we've got implied volatility and time, risk-free interest rate, dividend changes. in addition to stock price, affect our options. So getting a good foundation of understanding how I would use the same analogy, and I often use this in classes is surfing. It's, you know, you find a wave, you get on a board and you surf. It's that simple. But chances are you're going to fall down a lot. And the idea is you want to do that in someplace safe and do that with somebody who can help you point out that this is, I think, a really great analogy, because I use this in a lot of classes. Is like, that's a wave you don't want to get on. And if you get on this one, you want to get off before here. And so identifying that sort of stuff. And the other point that I was going to make is that you mentioned you just make a tweak to a trade, which sounds really great, but you and I both know not every trade can be adjusted. And so what that means is that, and what's really, really important to us, and hands down, the most important advice I can give anybody, if somebody wants to become a better trader, hands down, no question, the best advice I can tell you is define your exit plan. That is, what are you going to do when your trade works? So if you think the stock's going to go up, do you have a plan for what you're going to do? Are you going to hold the stock? Are you going to close it? Or alternatively, what happens if that doesn't happen? Are you going to take a loss? Are you going to adjust the trade into a covered call or a collar trade or something else? Having a plan ahead of time. And the key is to do that. You went through the options animal 6-step process a few episodes ago, and that's step 4. Step 5 is place the trade. So it's essential to have the plan in place. And just go ahead.
Sir, I was going to say, and the reason for that is it controls emotions. You know, emotions in the investing world equal failure. Or it equals highs and lows. Maybe you could get lucky with investing with emotion. But I think if you invest with emotion over the long term, you're eventually going to lose, especially with all of the advancements that have happened in the trading world in the last decade. I mean, this whole movement with 0-day to expiration options has just increased the incentive to become a gambler in the markets right now. And it's a huge risk right now, I believe, for retail investors to try to step away from the allure of, man, I can go ride this 1-day option and go buy something for 10 cents that's going to expire later today. But if I get a big move like we're having in the market today, right? Market's getting crushed today to the downside because of commentary from Powell in front of Congress. And we'll talk about that here in a minute. But the idea is, if I get this big move, I can turn this, $150 bet into $15,000 in a couple hours. And you can't do that, at least not long term, I don't think.
Well, you bring up 0-day, and that's the other thing. We didn't talk about that, but I know you saw my tweet yesterday. JP Morgan's global quantitative derivative strategy team came out with an analysis, and there's 2 key points in that. One is that the vast majority of the SPX traded, so literally 95% of the SPX options traded are institutions. 80% of the SPY, so SPX is the cash settled index. There's no stock, there's no underlying. You're just sort of betting on the direction. It's an index. That's getting that's a huge spike. The biggest volume is in the SPX, but some people are also trading the SPY, the SPY, which is an ETF, does have an underlying, these 0-day options. So 95% of the SPX is institution. 80% of the SPY is institution. So conversely, that's 5% retail, 20% retail. So 20% of people trading are retail traders. So this is, you're swimming, I imagine, like, looking at the ocean and there's blood in the water and there's a bunch of sharks swimming around and some retail traders looking to go in there. If you're in a market that's driven like 80% or more by institutions, they have skills and tools that you probably don't have as a retail trader. So you probably want to be really careful there. I think this is, it's a little bit scary. But the other thing is that was in this report by JP Morgan. They did an analysis, and it's pretty wonky to read the analysis. But the key was they looked at what would be the impact if there was a 5% move, how, based on the portfolio, by looking at the open interest and the volume of the contracts. What they did was they did an analysis and said, if we had a 5% move in the market, how would the option traders who are trading these SPXs, they have to unwind those trades if they move too much. How would that impact them? Because we know the Greeks, we know the delta and the gamma, and we know the volume in the market. We can run it through a model. And what they're saying is that if we saw a 5% shock in the market, it could result in up to a 20%. So 5% at 1 o'clock, by the end of the day, we'd be down 20%. That's pretty scary. So this is the Volmageddon that people are talking about, is could there be a volatility impact? And this is, I think, doesn't affect us in the long term. I think this 1 day, 0 day expiration thing, I think it all comes out in the wash at the end of the day. Literally at the end of the day, it comes out in the wash. But I think, long term, is it moving the market? That's not my fear. My fear is what happens in the short term.
Yeah, because that is the risk. I mean, they do have the circuit breakers that halt trading and try to curb trading when it starts to get, too much panic going on. I mean, those were first instituted, I believe, from the 1987 crash is why the New York Stock Exchange first put those in place. And I've only in my, I've been trading since, the early 90s. And my only experience in trading has seen those circuit breakers triggered only a couple of times since I've been trading. And so, yeah, that would be interesting that they could see that if we have a 5% down move, that it could start pushing through those circuit breakers that does cause the potential risk.
So there's something, something could break. I mean, 2018, we saw all kinds of crazy stuff happen with the VIX derivatives. So yeah, I don't think it's going to cause a major impact to the market or major pivot, like as opposed to something like this, which is what we were going to talk about today. So Chair Powell is speaking to Congress today and tomorrow. And surprise, surprise, he says the Fed is going to try and get inflation under control. Greg, were you surprised?
It wasn't new, right? In fact, I'll be honest. I mean, I haven't read his entire speech yet, but it doesn't seem like he's even as hawkish as he's been in the past. He just says the market's wrong. The market thinks we're not going to do what we say we're going to do. And so the market today is pricing it back in that the Fed's going to tighten rates still.
Well, jump right to that, to the CME tool. Yesterday we were at a 31%. So this our current rate is 450 to 475. So a 25 basis point would put us at 475, 500. A 50 basis point hike would put us to 500 and 525. Yesterday we were at a 31% probability of a 50 basis point hike, and today we're at 69. And a week ago or a month ago we were at 9%. So this is you and I were talking. I think there's a very interesting behavioral heuristic, if you will, of people wanting or thinking they're going to see what they need to see. So if you've got a portfolio that that doesn't do well under this rate increases, I think there's a bias, and you can almost sense it on Twitter, or people who are wanting to car bomb Jay Powell. I mean, I can't say how much I appreciate Jerome Powell. The fact that he has been so incredibly clear and forthright and consistent. There's no surprises here. To me, this is exactly what I expect. And I think it's refreshing for him to be candid and honest with us. And I think the reaction we're seeing in the market is people don't want that to happen. Like, I don't want it to go up. The market's having a tantrum. Here we're looking at a long-term chart or a 1-year chart, daily candles, and the green lines are the blue is the 50-day simple moving average. The red is the 100-day simple moving average, and the green is the 200-day simple moving average. Interesting. Last Friday, we definitely touched the 50 and the 200, and in one day we almost touched all three. That hasn't happened very often, where these get all three of them get so close. So we're at a major level of support. This the blue line crossing the green line is considered the golden cross. That's generally a very bullish signal. So I think from a technical standpoint, we're looking at a lot of support at 3,900. probably a good level of support. If we break below that, the next level down there is 3,800. Where we play out from here, I'm still forecasting. I think I had a 4,400 pick by the end of the year. Was what was my forecast in December. I still think that's fairly reasonable. I've seen other people that are bullish. I know Ken Fisher is in the belief that we are in the early stages of another bull market. Stifel put out a piece yesterday reiterating their call for 4,300. Those are rare because it seems like most other than Goldman Sachs, I think most others, including JP Morgan and Mike Wilson from Morgan Stanley, both JP Morgan is Kolovanik, both of those guys very bearish, and Michael Wilson every Monday putting out his piece, still calling this a bear rally. What's your thoughts overall on the market technically, Greg?
I think the story that's not a lot of people are talking about, we talked a lot about it when it happened, but the bond market, I think, is telling a different story than the equities market. The equities market this year has done really, really well. And in comparison to last year, at least, it's done really, really well. I know some people might say it hasn't done really, really well, especially the last month or so since we came off the highs in February. But we've had a bond market with an inverted yield curve that's as inverted as I have ever seen a yield curve. And a lot of people are saying, well, we're not going to go into recession, even though that's a really good indication of it. And so the bond market to me is telling, I think, a different story than the equities market. And just as an example, we went through, for the first time, we went through 2%, or excuse me, we went through 5% on the two-year bond today. The 2-year US Treasury yield is now yielding over 5%, and the 6-month is at 5.19%. Right now yield, and we've got a pretty inverted yield curve. And again, this to me, I know that it can stay inverted for a long time before we go into recession. It's not necessarily an indication of a recession is here right away, but it's pretty negative right now, and there's still a lot of push going into bonds. And I think that's just an indication of the bond market is actually listening to the Fed, I think, more than the stock market is. That they recognize that, yeah, the Fed's going to keep raising rates, and therefore we got to keep raising with them. The yields on the bond market are continuing to climb. And so I don't know. I'm still optimistic that I think most of the bad news from inflation is priced in. I think what the Fed is doing and being aggressive with rates is good for helping to battle the inflation problem that's out there, and not, giving up. That was the fear. I talked about that a few months ago in some of our recordings, that my fear was that the Fed was going to back off and say, okay, we're done, and then have inflation yield its ugly head again. I'm hoping that they'll get inflation under control. And I think by the back end of this year, there's a possibility that we get bullish, as long as in the short term, we don't break something. And you brought something else up that not everybody else is talking about right now either. And that's what's going on in the Bank of Japan. And that's a big deal that not a lot of people are talking about right now.
Yeah, that's where I thought you were going. So what aren't people talking about? And certainly this yield curve inversion is getting a lot of attention, and you're hearing people say this time is different. We will have another recession. The question is when. This is looking at the 3-month and the 10-year Treasury, the difference between the 10 and the 3-month. Sometimes it makes sense to look at other terms as well. The 10 and the 2-year are used a lot. But every time we've had an inversion, we do eventually get a recession. This is both indicative and causal, by the way. When you and I were at that conference, that Global Center for Interdependence, we had a conversation with a bunch of economists, and I asked the question, is the inverted yield curve a causal factor or a canary in a coal mine? And the answer is both. Having the yield curve inverted is bad for banks because banks loan out at the they borrow at the front month and loan at the short term, borrow at the short term and loan out at the long term. So this means they're paying more money than they can get for longer term. So this 3-month is close to where they borrow the money. It's more complicated than that, but that's the gist. So banks are not making money on loans with a yield curve. That's what that means. So that can cause a recession because it causes banks to do different things and rates to go up. And that's what the Fed wants, actually try and slow down the yield curve. But speaking of yield curve, when you think of yield curve, or if you talk to anybody who's in bonds, you talk about yield curve, the Bank of Japan has to come up in the discussion because they have had a policy of yield curve control, and they will go in to control their yield curve. And I don't have a chart of the Japan yield curve, but there's a very significant change going on. Kuroda, who's the chair of the Bank of Japan, is stepping down, and there's a new person coming in. And so he does have one meeting. So Governor Kuroda has a meeting this week. So on Thursday is a big meeting. Now, Bank of Japan is usually a boring meeting because it has been the most consistent for the past over a decade. They've had this policy. And I don't know that I'm smart enough to know all the implications, but I do know that there's a lot of money that's tied to the fact that Japan has this very stable market in yields. And I was at Camp Kotak, and one of the big hedge fund managers was talking about a strategy that they use where they're long one country, short another country, and then they're actually selling bonds, corporate bonds, and they're able to, off of that, basically get very low risk, almost free money. And the key of that is Japan maintaining that bond. And there are billions and billions, if not trillions of dollars tied. I don't know if it's trillions, but it's probably hundreds of billions. Because the person who said you need to have at least $1 billion to do this. When he said that, I kind of tuned out and didn't listen to the rest of the strategy. But there are a bunch of other people there who were interested. But nonetheless, if Japan changes its policy now, Kuroda, the new governor coming in, I think it's Ueda or something. I don't remember his name. But this one's still going to be run by Kuroda. It wouldn't be unexpected. It's not priced into the market, but there are people, specifically Goldman Sachs, is saying that there is a risk that Kuroda is going to recognize that they're going to go away from the new governor is going to go away from yield curve control, and they may make some announcement and take some action this week. And if it does, it's going to send some shockwaves through the market. I don't know which way it's going to go. It's going to be good or bad. What is it going to do? To me, it feels like the market is a little bit tense. We got the VIX right around 20 right now. There's a little bit of fear coming in. I think part of that is Jerome Powell, but I think a big part of it is nobody's talking about Bank of Japan. But I think at the end of the week, if Japan goes away from yield curve control, it'll be all over CNBC. And next week, we will all become experts in yield curve control from the Bank of Japan, just like we've been experts in Turkish debt and Greece debt in the past. I think this could potentially be the next big catalyst. Hopefully it passes and it's all smooth. But any thoughts on that, Greg?
Well, I have to agree with you that I don't 100% know what the outcome is going to be, but it is going to be something we have to pay attention to. If it goes down that path that you talked about, going down the path of Greece or Turkey, that would really concern me because Japan's a lot bigger player than Greece or Turkey, both in the size of their economy and their GDP in relation to global GDP, but also in the staggering amount of debt that does exist in Japan that is globally held. It's not just all owned by Japan. I know that they've been one of the main players financing their debt and using that yield curve control to do that over the last decade. But as that shuts off, we will see. I mean, it's one of those potential what ifs that you have to stay cautious right now to see what it may do to flows in the market. And that's really what we're talking about. We're talking about liquidity flows. I don't, does it change the fundamentals of Apple's earnings? Probably not. And if you get a short-term market reaction because of a credit event going on in Japan that causes Apple to go down 5% or 10%, it's probably going to create an opportunity to get into Apple. But in the short term, you still have to recognize that it could have an impact.
Right. So the key takeaway, I was just checking my notes from Goldman Sachs, was that any significant change in policy is probably going to have an upward pressure on other bonds, other domestics, so other central bank bonds, and also corporate bonds as well. So maybe somebody is looking at the TLT or the HYG as impacts. So I just something to keep an eye on. This is usually an area that's pretty mundane and a real snorer for the economy. But was there anything else we wanted to talk about? Did you?
Let's get together quicker than we did this last one. I know both of us have been a little busy, but
oh, you mean the time between meetings?
Yeah, time between our recordings. Our last one's like a week ago or so. So
I was going to share real quick on a Tesla. You probably can see my not a flamethrower over the side. Yeah, and just so you know that I'm responsible. That's a boring company, not a flamethrower. I have the boring company fire extinguisher just in case there's any issues.
Great. That's great.
So speaking of Elon Musk, some news this week on the Model S and X market doesn't seem to like it a lot. That's down 2%. This stock has been so volatile. We've had such a huge range of where this stock has been over the past year. This little move looks small, but it's a pretty significant move there. I think part of the bearish move, by the way, today is that one of the biggest proponents of Tesla has been Adam Jonas from Morgan Stanley. He's been a bull for a long time, and he's kind of leading the cheer. There's a lot of other bulls out there, but from analysts, he's been a long time bull. He is no longer putting Tesla as their number one stock to watch. And I told you who the new one is. The new one is
my dream car when I was in 8th grade.
Vroom vroom.
Yeah.
And I think this big move up, what we saw today, was because of this earlier this week is because Morgan Stanley has published this report. You can, those of you that are subscribers on Trader Oasis, you can read the report in the institutional insight section if you're interested. But I look at that chart and say, wow, but then it's 52-week highs. I don't know. Certainly a company that's very interesting.
I have such a hard time getting excited about an electric Ferrari. I mean, isn't the whole reason you spend $250,000 on a Ferrari is so that you can hear the whine of the engine, so that you can hear the sound of the pistons firing? And are they going to make up is there going to be like a soundboard so that you can still like hear the engine rev?
There is. They're going to have fake noise.
Oh, it's horrible. I love Ferraris. I always have, but good grief, really?
Yeah.
Anyway, stock's doing really well for sure.
It looks good. I don't know. I'm buying it at 52-week high. I don't know.
Yeah, I have a hard time saying I'm optimistic.
PE of 49 does pay a yield. Oh, this seems like a trophy stock to me. The kind of stock you want to, just like the cars or trophy cars. It's hard to make. It's hard to make that decision, but it was just a shocker to me as I just read it a couple of days ago that Adam Jonas that's his top pick now for. And by the way, his price target is only like, I think it's like 300 or something at 320. So it's not a huge move. And he's still bullish on Tesla. He just thinks Ferrari's a better buy now.
See, and for me, investing in the auto sector, when I think auto sector, I think I'm going to go buy shares of Chevron. I don't buy the actual auto manufacturers themselves. I'm going to buy the stuff that they use.
You should buy Oxy.
Or Occidental. Yeah, and Oxy's another. I actually think Oxy's probably in a better spot from
I know you do.
bullish standpoint than Chevron is.
Technical standpoint, Buffett's a fan. PE ratio of 4.9. Yeah, it's I think I'm not a big fan of the oil space, but and I know you like Chevron too, but I'm partial to Warren and Charlie, and they both they like the company. So
hard not to argue with their track record. They've got a pretty impressive track record. So
all right.
Well,
Well,
it's been too long, Eric. Let's do it again.
not this show. It's been packed with great information. The length has been great, but time.
No, I'm about to say it's been too long in between shows.
Yeah, exactly.
That's what I mean by it's been too long.
All right. I agree. We'll talk to you soon, and we'll try and get another one out. Maybe towards the end of the week after Bank of Japan. What do you think?
Yeah, sounds good.
Significant happens.
I can do that. Let's shoot for Friday morning. I think I'm doing the Options Animal weekly on Friday afternoon, so let's do it in the morning if you can. By the way, everyone, don't forget, like and subscribe. Ask us questions. We'd love to. Well, maybe that's something else we can talk about on Friday as well. Get into some more of the questions posed by the users and listeners.
Thanks, everybody. We'll see you later.
Thanks, everybody. See ya.